Welcome to my market commentary for the third quarter of 2023. Good morning. Well, so far, 2023 is turning out to be a year that I think most investors would really want to forget. Central banks have battled inflation with ever-rising interest rates, whilst the war in Ukraine continues unresolved and trade willingness between China and America continues to freeze. All of this has put great strain on households around the world as they try to balance the books in maintaining mortgage payments, feeding their families, and just keeping the lights on. The knock-on effect has been greater salary demands for employees and then smaller margins for businesses and the ever louder whispers of recession. The other unintended but catastrophic fallout is the impact that this has all had on bond markets. Now, many of you will know that bonds such as UK gilts and US treasuries are usually the safest place to invest. They're underwritten by well-capitalized and regulated governments, and they pay fixed interest returns to investors. However, over the past year or so, we've seen these traditionally cautious investments suffer some of the hardest falls, as interest rates have risen so swiftly. The more cautious bonds have been left behind and jettisoned around the world by markets. Having said all of that, July was actually a good month. Inflation figures in the US showed both general and core inflation falling, and the US Central Bank decided to pause their interest rate hike program. This offered real hope to both bond and equity markets. US equity markets flew up, partly fueled by technology stocks, whilst UK and US bond funds lifted, and our clients' portfolios enjoyed some excellent short-term recovery growth. However, August brought more gloom, as data from China started to show some serious recession concerns, such as large property developers filing for bankruptcy. And in the UK and US, we saw data that showed the inflation battle might not be over. And so bond and equity markets dropped again on the assumption that the relentless interest rate hike program will continue. The FTSE 100 fell by around 6.5% this quarter, which is really frustrating. None of our 8 model portfolios fell by as much as this, but it was impossible to avoid all of the losses as the world continues to deal with some really heavy challenges. So what on earth comes next? Well, we've been modelling 3 scenarios that we consider to be the most likely potential outcomes at Thomas & Thomas. And we've been asking ourselves here in our little team what each scenario could mean for our client portfolios. Here's what we're thinking. I feel like I'm on top of the pops here, if you remember that. Scenario 1, the bounce. If central banks become convinced that they've done it and created a soft landing for their economies, this could lead to a long-awaited bounce in equity markets. With recession avoided, we would expect the positivity in US markets or US equity markets of this year to spread into global positivity. This outcome really helps our level 3 to 5 risk portfolios, but it will also help our level 1 to 2 risk portfolios to some degree because of their partial equity content. Okay, scenario 2, what we've called the stubborn malaise. Now, we could continue in the strange paradigm of not quite recession for some time. In this instance, we see global markets remaining depressed and central banks slowing their rate hike programs in fear of tipping their economies into recession. This scenario sounds bad, but actually there is still hope for our portfolios, especially in levels 1 to 2, as the dividend and interest yields within their funds will be fairly meaningful. The average yield on FTSE 100 stocks alone is around 3.67% currently. This will help to slowly pull the portfolios back up, even during a depressed market. This scenario is probably the most frustrating and takes the longest to recover, but it still leads to a positive outcome over time, And don't forget that this scenario doesn't remain in place forever. And in scenario 3, global recession. This is the scenario that most folk are scared of. However, recession means the inflation fight is over. And let's just think through what happens next. Central banks then have little choice but to stimulate their strangled economies with rate cuts. China already started cutting their rates last week. In this scenario, all of our level 1 to 5 portfolios look set to benefit once rates start cutting, but the level 1 to 2 looks best positioned for this recession scenario. Now, there could be other scenarios, but really the important thing to notice is that recovery periods historically follow crashes. These recovery rallies are totally unpredictable and extremely fast when they happen. This is where the growth occurs. It's a fallacy to think that we can successfully jump out of and into markets to better our returns. In fact, I've lost count of the amount of times I've heard tales of woe due to investors trying to do just this. Investors who are saving monthly into the markets currently stand to profit over time as they continue to purchase cheaper units and stay fully invested in readiness for the change in markets. We've also noticed a very marked increase in our clients now investing new cash into the markets, as they can also see longer-term value on offer at today's prices. Quilter have just released a really good document called Investing in Uncertain Times, which is well worth a read. I've attached it to your proactive reviews. The work carried out by Quilter is compelling. If you were able to watch or attend my masterclass presentation on the markets back in July, you might notice some very similar types of charts. I think Quilter might have copied us. Anyway, if you could take 5 minutes to read it, I would highly recommend that you do so. You should find it very encouraging. As ever, we're here for you, right by your side. If there's anything you need at all, just let us know. My very best wishes, and I'll be back with you in December's market commentary.